Hi, good afternoon, everybody. My name is Sean van den Berg. Welcome to our webinar for today. Today's topic is conquering technical analysis. I'm very excited about this because obviously my background, I am a technical analyst. Here is the agenda for today. If you guys can hear me clearly, by the way, I've asked for some sound checks and no one came back to me. So I hope you can hear me. My objective today is just to introduce technical analysis and just simplify it. That's my objective today, to simplify it for the traders, and then obviously to bring a bit of psychology and a bit of a trading plan. But the objective today is to, especially for the novice investors, just to explain some of the methodology behind technical analysis. And when we come to the trading part, obviously the mindset and the money management is also very important. So this is our agenda for today. Just remember, with every webinar, any questions you have, just type them up in the little question box. And as we're going along, I'll pop in once in a while and see what questions there are. Try and keep it context orientated. If I don't answer any of your questions, I'll be answering your questions by email. And secondly, obviously, this presentation will be sent to everybody that's on the talk with us today, as well as the recording. Okay, so I hope you guys can hear me clearly. Okay. So, what is technical analysis? Just a quick overview of the simplified. There's two approaches or two categories used to analyze shares, to make investment decisions or trading decisions. Obviously, the first approach is what we call fundamental analysis. The school report there is obviously we look at the characteristics of a company, and your goal as a fundamental analyst is to determine what is the intrinsic value, what's the real value of the share. The share might be trading at 5 Rand on the market, but it's actually only worth you at 50. Then the company might be overvalued if you look at it that way. Or the company might be trading at 350, but it's actually worth 5 Rand. Therefore, it's undervalued and there's opportunity. So that's what a fundamental analyst will try and look at. On the other side of the scale, we've got what we call technical analysis. Now we're looking at maybe charts, graphs of the companies. So a technical analyst does not care about the value of the company. We believe that the value is reflected already in the price action. So that's what we focused on, is price action. And that is what we're going to focus on today mainly. Okay, what is price action? Basically, it's the study of supply and demand. And the idea there is that you're trying to determine what is the direction or the trend. We were discussing these things a bit later. Well, more importantly, will this trend continue into the future, or are we about to change direction? So we're trying to understand, obviously, the motions behind the price action. So it's the motions in the market. So the idea is that we study the market itself as opposed to the components. When we say components, obviously each individual player and that kind of stuff. So it's Mr. Market. I want to see it as a group of investors, a group of traders, what's happening with the market. So we use various technical indicators as well as oscillators, and I'll discuss this in more details a bit later. But also some of us might rely more on chart patterns. I, for one, like to use a combination of the two, chart patterns plus technical indicators and things like that. So the idea is to develop a style for yourself as a technical analyst. Okay. So let's talk about price action. Now, the simplest way to display price action is by looking at a price chart, and the simplest way of showing that is what they call a closing line chart. If you had to join the closing price of every day with a line, this is what the chart would look like. So first of all, you must understand charts are two-dimensional. You got on the vertical axis, you've got the price, and on the horizontal axis, you've got time. So here we're looking at a daily chart, and this is we're looking at SASL. Also, it's important to understand when we talk about log scaling. I always like to use log scaling because that smooths out the percentage movement. The share moves from 1 Rand to 2 Rand, it's a 100% movement. It goes from 2 Rand to 3 Rand, that's a 50% movement. So you don't want to be in a situation where the graph gets skewed. So that's why I prefer to use log scaling. You'll see that if I bring in my little cursor here quickly, my spotlight, by SASL's name, you'll see I've got log scaling here. Okay, so let's go back to my normal pen. That's the simplest way of looking at charts. The same graph now, what I'm going to do now is we bring up what we call a bar chart. Okay, let me just get my software to work. So catch up. There we go, a bar chart. So I have the same graph now of Sassel. What I've done now, you can see the time horizon, the horizontal axis has been zoomed in as such. I'm showing from April to October, so roughly about 6 months. So now you're seeing a bit more information. So you see the high for the day and the low for the day, what they call the trading range within a particular day period. This is a day. You can also have for the week or for the month, whatever the case might be, the highest point and the lowest point within that time period. That shows you the volatility also. The greater the bar, the greater the volatility. The smaller the bar, obviously less volatility. Your tick to the left is where the market opened at 9 o'clock, and the tick to the right is where the market closed at, or this particular share closed at 5 o'clock. So a lot more information. This information comes out of the JSE every day. And the fifth bit of information, obviously, is the volume, the number of shares traded. So this is another way of just adding onto your armory as a technical analyst, closing line chart and then bar chart. Within these bar charts, you'll pick up a lot of chart patterns. This is great for the swing trader. We pick up what they call gaps, and we talk about islands, and we talk about key reversal days, so and henceforth. So it helps you anticipate the change in trend the next day. We go one step further. We look at what they call Japanese candlesticks. Again, same time duration, same share, but now you start looking at much more information. What's important now is the relationship between the opening price and the closing price. So you can see here on our first little graph here, this colored in one. This one here, this is a situation where when they call it the real body, it's colored in, that's a negative day because the close is lower than the open. Okay, that's a bearish day. In this situation here, this is a positive day. The close is higher than the open. And obviously, you still got the high for the day and the low for the day. We talk about wicks, being a candlestick. We talk about wicks or the upper shadow and lower shadows and things like that. I'm not going to go into too much detail. We've got a webinar coming up in about 2-3 weeks' time regarding candlestick patterns. And obviously, what's important with candlestick patterns is recognizing it and anticipating what's going to happen from there. So those are the three basic charts most people use. And you can go one step further. You can also use little noughts and crosses, what we call point and figure charts. And I'll be discussing that also in the upcoming webinar. Those are the three charts most people would be using. As a novice, you're going to be using a line chart and a bar chart. And from there, as you get more knowledgeable about the markets, ultimately playing around with candlesticks. Okay, so let's talk about cycles. There are three important cycles to always understand. And I think a lot of us forget that the market has these three cycles. We have what they call the primary cycle, which is your primary bull and primary bear. This is your long-term cycle. Okay, definition of a bull market is higher highs, higher lows. Okay, and this is lasts from a few months to a few years. Definition of the bear market is lower highs, lower lows. Also lasts from a few months to a few years, but the duration is much shorter. So you can see over here, this is again Sassel. I've compressed it now. This is, you can see in the top left-hand corner here. It's a weekly chart. Going right back to 1994. When software, and we're talking about when a bit later, you can go right back to 1985. So it gives you a lot of information. It gives you the perspective, where has the share been and where it's going to from now. But here's an example of a situation where we have lower lows and lower highs. Same thing over here. Okay. But ultimately, you can see that this is a long-term bull market. The secular trend is up. We've gone from, remember this is the price axis, we've gone from 20 Rand 75 and very close, we're trading very close to 500 Rand a share. That gives you the perspective where it's going. Okay, so we've been at long-term bull market where there's what they call the secondary cycles. These are the corrections and rallies. So, this might have been a bit of a bear market, which is roughly about 2 years. But you can also see in the long-term cycle, that could have been a correction. Okay, same thing here. That would have been a correction here. Okay, just it's a trend against the long-term primary trend. And obviously rallies would be the opposite. In the bear market, and obviously a bear market is just doing the opposite where the trend is down. And that's what's been happening with the Japanese stock market. They've been in the long-term bear market. So a rally will be something against going a movement up against that prevailing downtrend. Okay. And then everybody gets always fixated on the minus cycle, today's close compared to yesterday, or for example Monday, or today's close compared to a week ago. Your goal as a technical analyst is to determine where are we now on the primary cycle, are we in the bull market, bear market, and then from there, anticipate, are we in a correction already? Okay, and obviously be in the right side of the market. So that is what your goal is as a technical analyst. Even as a short-term trader, your goal is still to look at the primary trend. Okay. Let's look at some tools that we use now in technical analysis. We talk about support and resistance levels. So I just want to let you understand that support and resistance levels are horizontal lines. So the idea is that we want to find an area of support. Okay, it's like a floor. So you can see the share price has touched quite a few times at that level. Okay, that's what we call support. And if I can give you a word of advice, always try and make your graphs very visual. So in this situation, I like to draw my trend lines as red, so support, and on the other side of the scale, my resistance, the seeding, I like to make them blue. You see that's the area of a touch there and a touch over here. That's quite reliable, touch twice. Ideally in this situation, you'd like to touch it more times, like we have with the support level. But you can see in this sideways market, the market is moving sideways, and that was for nearly 3 years. Okay, and we have this breakout. We talk about breakout above resistance, and the trend continued up. So the trend was up, then we moved sideways, and then broke out of that trend. Same thing over here. We moved sideways market. Okay, this is what you want to try and also find is turning points. What I call turning points. Here was a previous support level, becomes resistance, becomes support. That's a very, very reliable level. So roughly here about 315 Rand on SAS at that point in time was a very, very important level. So we've broken out above that level, came back to kiss it, and then says, bye, I'm out of here. So we need to go way above our previous high. So you can again extrapolate another resistance level above that. That 500 Rand level is important. Okay. So just understand support and resistance levels are horizontal. We go to things that are called trend lines. Now trend lines, idea is to find a prominent low and project it to a second point, and ideally a third time, fourth time, and so we go and extrapolate it out. As the word implies, it supports prices. As long as the share price stays above that support trend line, the trend is up. Okay. And then when we break out below that trend line, it's a change in trend. So you use trend lines as a trigger to get in and out the market. So we use it for what we call entry and exit points. What I always try and find is, try and create is what I call parallel lines. Okay, or I call a trading range, or a channel, up channel. You see the market's moving a nice little channel there. So obviously the lower level is what we call a support trend line. Touched quite a few times because it's quite reliable. And on the top side, it's only touched twice. We're heading back towards hitting that resistance level. Okay. So obviously when we hit that resistance level, we can anticipate either it's going to break out or it's going to test it and come back again. Fail to break out above it. Okay. So there's some rules involved with trend lines, and there's 5 things we're always looking at. First of all, obviously the length of the trend line. Okay, you saw now on a long-term weekly chart, the number of points touching, the greater the number of points touching, the importance is that the trend line has been confirmed, or the trend line is supportive of the share price. Okay, the longer the trend line is intact, the greater the importance of that trend line. So that's very, very important. Sometimes you have what they call minor penetrations. You might have little false breakouts and things like that. And that's why it's important to have other confirming factors. And we're talking about moving averages just now. But these are tools that will help to confirm a break of the trend and a reversal of the trend. Okay, we talk about reversal of the direction of the market. So the idea there is to prevent you losing money. Those are the tools we use with regards to trend lines. Okay. What is a valid penetration, a valid change in trend? I always like to look for a close above or below a trend line. You go one step further and have a rule that must close at least 3% above or below that trend line for you to confirm a change in trend. So it's important to have those confirmations, what they call confirmation rules. Okay. You can also use trend lines to help you with price objectives, especially with sideways markets. We talk about creating rectangle patterns. What you want to do is measure the distance equal to the vertical distance. So, for example, the distance between the support level and the resistance level might be 5 Rand. If it breaks up to the upside, I can add 5 Rand. If it breaks down to the downside, I can also add 5 Rand. So it gives you that price objective. Okay. We talk about high probability trading. Those are the kind of things you're using. The trend lines are very important in that sense. Another way of looking at it, trend lines, is the angle of the ascent or descent. An ideal situation always looking for is a 45-degree angle. Okay, that is basically the price and time are in perfect balance. Okay, so you're looking for that angle. Basically, you're looking at for something that's going to be sustainable. We always find that that 45-degree angle, the share price moves up in those degrees, the trend will carry on for a long time, so the trend is sustainable. If the angle starts moving up towards like 60 degrees, that angle is not sustainable and the market will change direction. Okay, so there's just some background quickly with regards trend lines. Very useful. So quickly, just to summarize, price action, very important. My number one primary indicator is price action. So I look at my price charts, especially candlesticks. I use support and resistance trend lines, especially for entry and exit points, but also to help me anticipate turning points in the market. Remember those 5 rules with regards to trend lines. So let's move on to some technical indicators. We're going to discuss some of the basics, moving averages, moving average convergence, divergence, or MACD, RSI, stochastic, on-balance volume, volume price trend. Because remember, at the end of the day, technical analysis looks at 2 factors, price and volume. Price is people's, as I say, supply and demand, and volume is people's commitment to price. Okay, so let's get into it. I like to use a 50-day and a 200-day moving average. So obviously, yeah, at this point in time, we're looking at a weekly chart of Sassel. So this would be a 50-week moving average and a 200-week moving average. But it can also be the same thing for a daily graph. We talk about a death cross and we talk about the golden cross. When that 50-day moving average crosses above the 200-day moving average, we call that a golden cross. Now, anything above that will be good news, like we have at the moment here. This is good news. The trend is up. Okay. So you use the 200-day moving average to help you determine should you be buying, or we're looking at CFDs and single stock futures. What kind of position should we open? You should be more on the long side than on the short side. Okay. If it was the other way around and the share price, the 50-day moving average crossed below the 200-day moving average, that's what we call the death cross, and the trend will be down. In other words, anything below the share price was bad news, so you should be more on the short side, take advantage of falling share prices. Okay, so one thing that moving averages are not good at is in the sideways market. Okay, like we have here, for nearly 2 years, Sassel moves sideways. So this is where moving averages can give you false signals, what we call whipsaws. Okay, in and out the market, in and out. So who's making the money in that situation? Obviously, is the broker or stockbroker's commission. Okay, so that's what we call a sideways or trading range. Okay, try to avoid those kind of markets. You want to be in the market where it's trending. We're either moving up, there's a definite trend up, or a definite trend down. Those are the markets you always want to be trading. Sideways markets, you want to avoid those. You want to wait for the breakout. You see when the breakout happened here, it broke out nice and sharply. You want to take advantage of the breakout. Okay, but you do not want to try trading or range markets. Okay. So how do you take advantage of the market? You want to try and get as close to the bottom of the cycle as possible and close to the top of the cycle as possible. And we talk about taking advantage of overbought and oversold levels. So here's an indicator called MACD. MACD stands for Moving Average Convergence Divergence. 2 moving average periods coming together and then moving apart. So you can see here the indicator, there's 3 moving averages involved. So that's a difference between the 25-day moving average minus a 12-day creates a 3rd moving average, and we put a 4th moving average on top of that called a 9-day trigger. So this little black line here is the MACD, okay, and then the little dotted line, okay, that little dotted line is what we call the 9-day trigger. So first of all, it's an oscillator. When I say oscillator, it moves above and below a 0 line. So anything above the 0 line is what we call overbought. Okay, there's more buyers than sellers pushing the price up. Okay, anything below the 0 line is what we call oversold. There are more sellers than buyers pushing the price down. Okay, so this is where you want to get excited when the market falls. That's where you want to get in. Okay, so there's 2 ways to use the MACD. First of all, what I call the crossover of the trigger line. So when the MACD crosses this trigger line, in this situation, I've got a little alert set up. That's where you want to try and get in. Okay, and obviously when it comes down to it, that's where you're going to get out, like we've got over here. The challenge is that sometimes you have little false signals, in and out the market, in and out the market. I like to go one step further. Same graph now, I use a crossover of the 0 line now. So when the MACD indicator goes above the 0 line, I like to buy it. When it comes down through it, I sell. So yes, I'm not getting exactly right near the bottom. I'm getting it over there, and I'm getting out over there. So I'm missing the first 10%, and I'm missing the top 10%. So if I can take advantage of the 80% movement in between, I'll be making money. And that's the objective of what I do here. Okay, there I buy again, and that's where you'd sell. Okay, that's where you buy again, and I haven't got a sell signal yet. So your trades are not so often, it doesn't happen so often, okay, but you'll be taking advantage of the bigger moves in the market. So what I like about the MACD, remember I spoke about trending markets and sideways markets. Some indicators work well in sideways markets, some indicators work well in trending markets. MACD works well in both markets. Okay, so that's one of the first things I like to help to determine price action is I look at is MACD. Ideal situation, obviously, as far as below that zero line as possible, that's oversold. So I'm trying to get as close as bottom as possible there. As I say, I want confirmation. That's how I would have got in. Okay, same thing here. That is seriously overbought. We haven't been up top here for a long time. You can see that the average, every time we get roughly about 700, that's when the market pulls back. At this level here, at 1200, we're seriously overbought. So we should be pulling back soon. So let's look at one kind of oscillator. Let's look at another indicator called a RSI. RSI stands for Relative Strength Index. I'm not going to go into too much detail about the formula. Basically looking at the strength of the share against its past performance. Now this indicator is with MACD and moving averages, you find that those are lagging indicators. It tells you after the fact that the trend is changing. Now, the RSI is a leading indicator in the sense that it highlights what they call divergence. Now you can see the share price is making new highs. Okay, that high is higher than that one, but the indicator is failing to confirm that. That's what we call bearish divergence. It's telling you, watch out, they should be changing direction soon. There we go. So it's that early warning system. Same thing over here. You see those 2 days are making higher highs, but the indicator is doing the opposite. Watch out, they should be changing direction soon. Okay. So that's what we call a bullish divergence. So RSI works on a scale of 0 to 100. Okay. Anything below 30 is what we call oversold again. Okay. Anything above 70 is what we call overbought. Okay, so the analogy is when it moves above 70, it's like elastic band. It's gone too far overboard, it has to pull back. Gone too far overboard, it has to pull back. The same thing on the other side of the equation. When it breaks below 30, it's gone too far oversold, it has to come back. Okay, so that's what the RSI indicator does. Go one step further, we can look at what they call a stochastic indicator. Now, the idea of the stochastic indicator looks at remember we spoke about a bar chart, the high-low range. Now we look at the close relative to that high-low range. And as the close, you find it in the uptrend, the close relative to that high-low range moves closer and closer to the high. And as the share price drops, the close relative to the high-low range moves closer and closer to the low. Okay, so we're looking at that relationship. Very similar to RSI, but slightly different. But I like to do is combine the two together, as I say, they're both on the scale of 0 to 100. Again, you can see bearish divergence being happening here. Also confirming that. So you get two indicators telling you watch out, they should be changing direction. So now you could have gone short on Sassel at that point in time over there, take advantage of that falling share price there. Okay. So that's what the stochastic does. This is how I like to group them together. So these are all my 3 oscillators we spoke about already. This point in time, as I said, the trend is bullish on Sassel. Okay, I wonder if I can buy them right now. On the stochastic tells me we're still coming down and we're coming closer and closer to overbought territory. So yes, this will be on my watch list to be watching very, very closely. You can see at least come way back below oversold territory and move up. So I'll be watching, this will be on my trade or watch list as a long coming up very soon. So you might anticipate the market pulling back towards this 50-day moving average. I haven't really spoken about it today, but you can draw in retracement levels and anticipate how far will the market pull back. Roughly about a third. On average, I like to always trade near the 50%. Okay. So this will be a trade I'll be watching very, very closely in the next week or so to go long on Sassel. So that is looking at price indicators. Let's go one step further, look at volume. Now volume usually gets displayed in the bottom of the screen in the form of a histogram. Okay, now on balance volume is a running total of volume. So if the price goes up, we add the volume. If price falls, we subtract the volume. Okay, very, very simple indicator. What I suggest you do is always put a 10-day moving average on this. What you want to look for is those sharp angles. You see a lot of volumes are traded here. Okay, those are the big guys coming to the market, institutions. So at that point in time there, big money came to the market, and that's why we have this movement. What's important, this is what we call volume accumulation. Okay, institutions are buying into interstitial, and hence is why we have this price advance. What's important now, those two graphs should be the same, the trend should be the same. So volume is confirming price action. Go one step further now. This is another indicator I like to look at, what I call volume price trend. Now we look at the percentage of volume. Okay, the greater the percentage movement, the greater the volume I put on. Okay, so I'm looking at the true picture of supply and demand. So going back here again, okay, here the price jumped up quite a lot. There we go. I want to get in as close to the bottom as possible. I want to piggyback where the institutions are moving. You and I, as private investors, have one major advantage over the institutions. We have flexibility. We can get in and out of the market faster than they can. Okay, so again, that's where you've got a bit of volume accumulation, and there's a bit of volume distribution, and again, volume accumulation, so it goes on. I like to go and combine the two together. Okay, gives me that confirmation over there. That would have been an ideal time to buy, and same thing over here. Okay, so it's going to be very close together. So now I combine my volume indicators with my technical indicators, so I'm betting the odds in my favor. Okay, so it's only the 3 or 4 indicators that I'm looking at. Remember, what's important is the thinking behind it. We're talking about the psychology just now. Go one step further. We want to see the share that you are trading now. Are we beating the market? So this is what we call relative strength analysis. So this is taking one data stream divided by another data stream. So I'm taking SASL relative to all the other shares in the market. So basically you're looking at are there better opportunities somewhere else. So at this point in time, okay, you can see the trend is up. That's what we call market outperformance. So SASL outperforming relative to all the other shares in the market. But there was a time where it was underperforming. You see that scenario there. In other words, when the share was moving sideways, it was telling you there's better opportunity somewhere else. The share is doing better at that point in time. You can also see it's below zero lines. At that point in time, it was seriously underperforming. Okay. Now, what I found was interesting when I was doing this analysis that here's SASL relative to the top 30 financial industrial companies. Okay. It's actually underperforming relative to the top 30 financial industrial shares. Okay, that's quite interesting. So the trend might be up, but it's also telling you there are better opportunities in the financial industrial sector. Obviously, the Rand edge stocks, especially the SA breweries and the British American Tobacco and the Richmonds, they've been in vogue recently, and hence the performance of the 30 stocks. But that just tells you that there's better opportunity somewhere else. Okay, so this is how you could put it all together. So this is what I always look at, combine it all together, and I make an informed decision from there. Okay, so if I look at this right now, I don't own any shares from a trading point of view. This will be still a watch for me. There's always 4 scenarios: a buy, sell, watch, or hold. My last signal was if I look at it this way, that was a sell. That was a sell there. Same thing here, short term. So my last signal was a sell. I haven't got any buy signals right now, so this will be a watch. Okay. So guys, that's what we call methodology. So we talk about chart setups. A chart setup is a situation where all or most of the chart conditions are right for a long situation when you go buy, or you want to sell, or you want to go short. So right conditions are obviously dependent on the setup. And they also may or may not include other indicators. So when I talk about chart setups, it's mainly the price action. So we could talk about simplified charts by looking at a normal bar chart, support and resistance trend lines, maybe overlaid with some moving averages. That is what we call a basic chart setup, and I'm looking for a breakout from there. Okay, so we're looking at things like technical indicators being a secondary indicator to support price and volume action. Okay, so those 5 or 6 indicators I spoke about now, I use it personally as a secondary indicator. I just found sometimes they give you conflicting information. When you have conflicting information, it creates uncertainty, and then obviously that's doubt, and you don't put a trade on. But the whole idea is they should indicate or support what the action is. In other words, not what to do, but or when to do it, but this is what's happening in the market, and then you make a decision from there. So a lot of these things are self-fulfilling prophecies, okay, as more and more people get involved with technical analysis and chart patterns, because everybody starts seeing the same things. Hey, yes, it's a head and shoulders formation, I can anticipate a reversal, or this might be a breakout soon. So that could happen here in South Africa, but I believe we've still got a long way to go. Because 90% of the market are sold the institutions, the pension funds and those kind of things. But if you can have an early edge, I call it an edge, if you can anticipate these things before the rest of the market, in other words, early identification of a possible chart setup, you can get in a bit earlier, you'll be making money. Okay. So what's important is the influence or the indicator or the interpretation of those indicators. That's what's important. So only over a period of time with experience and understand how these indicators will work, will you be able to trust your own chart setups. Okay. And how do you start testing them, or how do you start trusting them? You start back testing them with hindsight. Okay, that's a nice thing about the web software, by the way. I can cut off data and say, okay, this was today, what would happen? I can move forward in time there. So it's with what I call my trading simulator. But you can also simulate the stock market by using a simulator and say, okay, if I bought a share today, what would happen? But pick a share, a candidate, plan your trade, and then execute the plan. Okay, start small, and that's how you get to learn more about technical analysis. So obviously primary trend is very important, as I mentioned just now. The more you have confidence in the primary trend, the better you'll be for you. And obviously changes in the volume, especially when it comes to price targets, will also be very important. Okay, so we talk about volume spikes and things like that. So the idea is to play with different levels, different charts. Okay, especially using different time periods. Okay, you saw me using a daily chart and a weekly chart. The ideal situation, you want to use support and resistance levels on different charts, and ideally you want to see those price levels coming up in different charts to confirm a possible change in trend. So any a breakout above a support and resistance levels will be a further confirmation, especially on increased volume. Okay. So we'll talk about stop losses in more detail just now, but ideally you should never be losing more than 2-3% on a trade. Okay, and there's two ways to look at it just now. Okay, so you'll find that smart money puts on trades when the market's quiet, like we saw on Monday. Okay, with the public holiday yesterday, a lot of people, the clever money would put trades in on Monday afternoon, anticipation that the market will be bouncing back today, whatever the case might be. Okay, there's a cliche in the market: buy on rumor and sell on fact, sell on the news. So you're buying the pullbacks and you want to sell at resistance. Okay. So let's move on. We're running out of time. Let's talk about the psychology of trading. This is what I call the mindset. Now, this is a definition I came across of a successful trader. I can't remember where I found it, but definition of a successful trader is someone who feels good about themselves as a trader and also enjoys playing the game of trading. Okay, and I thought that's a very useful definition. So as long as you're feeling good about yourself as a trader and you're enjoying the game, I think you're successful as a trader. So when we talk about mindset or psychology of trading, basically is that battle with yourself, your emotions. Okay. Before you can win in the market, you have to win with yourself. So it's your mental and emotional states. That's what we're talking about when we're talking about your mindset or the trading psychology. Okay. It's how you approach your trading, and obviously having the right mindset is what's important. So it's, again, with hindsight, you can go back in time and say, okay, when I put this trade on, what was I thinking, what was I feeling, and things like that. And so you can start teaching yourself about it. Your main goal is to be be clear about what's happening in the market. So the idea is to be objective in your trades. So keep your emotions under control. Yes, we're on the one side of the scale, we've got greed, on the other side of the scale, we've got fear. Position yourself right in the middle, what we call being objective. So it's being aware of that. And the only way to control that is through the process of what we call discipline. Sticking to the plan. Plan the trade and trade the plan. So what I find useful is visualizing yourself as a successful trader. What makes a successful trader? And then become that person. Okay, the more you focus on it and you visualize it and you feel it and you affirm it to yourself, that's what I'm doing, that's what I'm doing, you'll become that kind of person. You'll make less and less mistakes. So now some of you might think, well, Sean's going off a path here into La La Land. But I found it's important to do this. Visualize yourself as a successful trader. So the top rugby players and the top boxers in the world visualize themselves as being successful. Why can't you do it as a trader? Okay. So we're talking about controlling your emotions. Spend every day writing down your trade. I like to keep a trading journal. Okay? Every single trade I put on, and then every day when I do my homework, my analysis of the day, I look back and say, okay, what did I do right? What did I do wrong? What can I improve on? Okay. So the idea is that you don't take your losses personally, treat it as a business. Okay? So obviously your self-image as a winning trader is important. We spoke about it just now. Okay. So the idea is to find a system. Remember, the system is an acronym. Save yourself significant time, energy, and money. Don't go and reinvent the wheel. I'm trying to highlight for you guys here a very simple methodology, and then we'll be talking about mindset and that just now. But more importantly is your money management. So back test your ideas, paper trade, use the Excel spreadsheet, but also just start small. Let's open up one contract on a share, okay, on single stock futures and see how that goes. Okay, and obviously as you get more knowledge and experience and more confidence, you add to that position. The biggest thing for most people, they do not have the confidence and they fail to pull the trigger. Okay, and they miss the one trade on next day. Next day is another thing. Before they know it's a week, before they know it's a month, before they know it's a year. Start small. That's one of the best ways to learn to trade. Okay, so let's talk about the trading plan. Before we get into the trading plan, I like to talk about the 3 M's. We spoke about it already. Methodology, your trading method. Okay, we talk about breakout trading. We talk about what they call tag trading. There's all different ways of getting into the market. And I spoke about various technical indicators. That's all part of the methodology. That's the easy part. The challenge is the mindset, the psychology, being in control of your emotions. But the most important is your money management. We talk about money management. There's 2 parts to it. We talk about risk management and money management. Okay, and that should be all. Those 3 elements should be inside your trading plan. So I'm just trying to simplify a trading plan here for you. There's 8 questions you want to ask yourself. What kind of market? What market do you want to trade? Are you be trading the top 40? Or you be trading the next 60 companies? In other words, on our top 40 list, our single stock futures and our CFD list, we only trade the top 100 anyway. So from there, you want to make that list a bit smaller. So you need to decide for yourself, what am I going to trade? Are you going to be trading CFDs or are you going to be trading single stock futures? I suggest open up both accounts. It doesn't cost you anything. This is great for what we call a swing trader. Most people will be what we call swing traders, holding a position from 2 days up to 30 days. Here we go. Okay. Some of you might be day traders. And that's for, I believe that's more for the advanced trader. That's where you'll be using things like the index futures, trading the Aussie contracts. Maybe as a stepping stone, you might use the All Me. You can go one step further, you can look at the currency futures. That's what we call day traders. Someone doesn't want to carry a position overnight, too risky, you're in and out the market, 3 or 4, a few points in and out every time, but you're doing it quite actively a few times a day. Some of you might be more what you call position traders, and that's what I like to do. I'm a position trader. I hold my trades from a few weeks to a few months, and that's ideal for the CFDs. Because remember, there's no expiry. And by the way, all these things I'll be talking about in 2 weeks' time, we'll talk about trading equity derivatives. Okay. So what time frame would you be trading? It's also very important to have that kind of knowledge, that kind of information. So a lot of us chop and change. First of all, a day trader, and then we swing to swing trade, especially when the trader goes against us. Stick to your plan. Okay. So as I say, your methodology, what your strategies you're using. We talk about breakouts from continuation patterns. I like to use that. When you say continuation patterns, it's your rectangles, your triangles, that kind of things. And then also try and bounce off either overbought, oversold levels, we go long, or we go short and oversold levels. Okay, so that's where the secondary indicators come in. Your entry rules, when would you enter a trade? Okay, when you enter the trade, when you break out above resistance, or you go short, when it breaks out below a support trend line. Okay, that's when you enter your support and resistance, sorry, your entry levels. When you would like get out of the trade, okay, we talk about a target price or take profit. That I usually use chart patterns, or I use retracement levels and those kind of things. A lot of times, support and resistance levels. Previous support, previous resistance levels, those will be my target levels, because the market will go and try and retest those levels. That gives you the target price. The idea here is taking the emotions out of the trade, because I know where the market's going. Also, very importantly, my stop loss comes from my charts. Okay, not a thumb suck. My charts will tell me where to put my support and resistance, my stop loss. It's just below support if I'm long, and just above resistance if I'm short. Okay. when do you trade and when do you not trade. I find it so much better to first trade on when I've done my homework. Okay, I've analyzed the market, especially on Sunday afternoon for the trades for the week ahead, or I've analyzed the night before and I've reviewed my trades the next day. The bottom line is that old Boy Scout motto: be prepared. If I'm prepared, I'm a bit more confident and I feel much better about my trade. I do not trade on the impulse. Okay, I do not trade when I've done no homework, or on a thumb suck, or I'm tired, or I'm late. In the sense that I should have put the trade on earlier. Now the market's open already. It's 2 hours into the trade. I missed the bus. I'll rather come back another day. So you need to have those rules for yourself. But number 8 is the most important. What risk and money management price are you using? So my stop loss levels comes from my charts. When we talk about risk management, money management, we're talking about risk reward ratio. You should never risk more than 1 rand to make 2 rand. That's the minimum scenario. And you'll see some examples just now. This is what we call position sizing. You should never risk more than 2% per trade of your capital per trade. Okay. So what are the trading tools? Use the watch list on our website, big time saver, in the sense that you combine the fundamentals with the technicals, and obviously you can split it between 2 different watch lists. Okay, I like to look at mining and resources, financials, industrials. I can see where the price action is happening. Secondly, to make money as a trader, you need some technical analysis software. And I know some of the questions are coming up just now. Do I need technical analysis as a trader? Yes. Okay. You'll be more informed, make more informed decisions. And we spoke about that already. And then I mentioned already risk management. Those are the 3 things you basically need to get started. Those are your trading tools. Okay. So one of the tools that we do have and we put out every day is what we call the Stockbroker Report. It's ideally for existing clients, with single stock futures and CFD clients. When I say fully funded, you've opened up the account and there's money in there already. So we give you daily updates. We break out all these things for you. So this is the last 2 trades we've done. AccuCap. Okay. We went on the 26th of August. Okay. We went long on this trade at 41 rand, 41 rand 60. This is what the actual report looked like. We give you a spiel. Okay. We're anticipating a breakout above that resistance trend line. Okay. So there we go. Break the whole thing down. We tell you where to get in, where to get out, and a risk reward ratio. That was my potential profit per share. In other words, I had a potential of making 11% on the share. Now this is a mid-cap stock, so it's the next 60 companies. So you need 79% margin on CFD. You had a potential of making 63% returns on that trade. And on our stockbroker, our average trade is about 12 days, by the way. So here's my risk reward ratio on 100,000 rand trading capital. I'm willing to risk 2%, which is 2,000 rand. Divide my stop loss, which is the difference between my entry level and my stop. In this situation, 160. Dividing 160 into my 2,000 rand per trade. In this situation, my position size is telling me, okay, I can go buy 1,250 shares on a CFD, on single stock futures. I can go buy 12 contracts. Okay, 1 contract is equal to 100 shares. Okay. So anyway, this is what happened with this trade. And lo and behold, we put out our recommendation this morning. We closed out. We revised our take profit down, okay, to Friday, to Monday's close. So in the auction, you would have got out this morning. Okay, so you made 7%. So based on your 17.5%, that wasn't shabby for that time period. Okay, so that's what we traded. We're top of the market, near the top of our range there. I decided to get out because I thought we were getting overbought and the market being jittery at the moment. I thought, I'm happy with that profit, let's pocket it. Okay. That was the one trade. The other trade we put on recently was MTN, also a breakout. It was a trader's nice little channel, broke out of that channel, and we're bouncing off this long-term support trend line. We're oversold. So all these things came together. Okay, yeah, we had a potential of 11% on this trade. You could have bought 2 contracts on single stock futures or 221 shares on CFDs. We revised our take profit. Our original take profit was 205, which is the top of this channel, but extended out. We revised it down to 199 first of all, and then we revised it down a bit lower. But we got out. So yes, we gave back some of our profits, but we basically made still 31% in 5 or 6 days. Okay. So that's what our stockbroker does, and this is how all these things culminate as a trader. You want to use different technical analysis, very simple charts. And so I'm using two oscillators, but mainly the breakouts of the support and resistance trend lines will help me get in and out the market. Okay. So guys, before we handle any questions, this is what's coming up next. On the 2nd of October, we'll be discussing trading equity derivatives. So those of you who don't know anything about single stock futures, CFDs, Aussie trading, there's your opportunity. So this will be our midday power hour lunch. And then we're going to test evening webinars. In the past, I've done 1 or 2. They haven't had a good support. So now I'm going to promote this. And yes, I am repeating the 11th of September. Those of you guys might have missed it. But it'll be obviously for the guys that are coming home after work or might still be at work. I'm going to see what kind of take-up we have on these 2 webinars. So yes, this will be the repeat of that on the end of October for the people that maybe are looking at the evening webinar. So I'll see how these things go, evening ones, and we'll have again also obviously in November and maybe one in December. But there'll be one on fundamental analysis. There'll be one on Japanese candlesticks. That was very popular. This is on demand. People have asked me to repeat it again. So I did this beginning of the year, and I think I did it in February and March. So I'll be repeating it now in November. And then more fundamentals. This is more the strategy as an investor. And then very similar to my Japanese candlesticks is pointing figure charts. I believe this is the forgotten art of noughts and crosses. So very important, like we had with this webinar. Please first come, first serve. 100 people, and you have your place. And then we have our last few forum meetings. I've got in Durban in 2 weeks' time. Monday the 7th of October, I'm coming to the Blue Waters Hotel. I'm here in Joburg for our last one for the year, and I come back to Cape Town again on the 10th of December. This is an opportunity where we talk about the market in general. You can meet me, ask me questions about the market, but I show you how to trade face to face. Okay. So guys, quickly before you get to any questions, obviously the objective today was to focus on basic technical analysis, but also to highlight for you that there are tools available for you, like the wind charts, these charts you saw just now. The software is for free. All you have to do is subscribe to the download services. It's a tool. There are a lot of other programs out there that cost you at least 5,000 Rand, but you need that tool to make more informed decisions. So you can either use ours or anything else, or any other program, but you need that tool to make informed decisions. And as I say, you can also use the stockbroker as a tool to highlight opportunities for you or confirm existing trades. But basically, I'll be discussing it in more webinars coming up, further technical analysis, and I have done in the past more advanced technical analysis. Okay. So guys, let me see if there are any questions coming through. Doesn't look like it. Still no graph, still no graph shown. I don't know what I mean by that. So we just grab this quickly. Maximize this out so I can see clearly some of the questions. Thanks for all the questions, guys. Just keep them coming through. Wow, quite a few questions. So hello, yes, great to have you on the webinar. Do you need special software to do technical analysis? Doesn't have to be special, as I just mentioned now. You just need some technical analysis. There is limited technical analysis available on the website, but ideally you want to be able to draw trend lines and that, and stuff on the website doesn't do that. So maybe look at our wind software. Thanks, Michael. Yes, you guys can hear me clearly. Thank you. Thanks, Donnie. Okay. Hannes says the audio is breaking up. So this is being recorded, so if it is breaking up, maybe Alistair, how do you find the return on capital employed on your PSG website? Return on capital employed. Okay. On every single company, on every company analysis, there'll be a return on capital. So there is that return on equity side, and there's a return on capital. One of the on the table, you look at on the company analysis that IFR puts out, you'll see there's a return on capital. I know we're digressing a bit off technicals, but that's on the fundamentals. So I hope that answers your question, Alistair. Michelle, can you hear me? Great. What is your strategy on the week chart, and which strategies do you use? Alistair? Okay. As I mentioned, the idea is that you want to switch between weekly charts and daily charts. As I say, I like to use weekly charts to show you the bigger perspective where the share has been. But also I use it for support and resistance levels. So if I draw a support level on a weekly chart and it happens to be 10 Rand, and I go over to the daily chart, and also happens to be a support level on the daily chart, then I know that's important. Okay, that's how I like to use the two together. So you go from a weekly chart to a daily chart, and ultimately to maybe to a intraday chart or a intraday price on your trading platform to enter the price. But that's how you use the two charts together. I hope that answers your question. Okay, here's a question from Stephen. How many times do you roll over on a CFF, a single stock future? Okay, I'm not 100% sure of your question, Stephen, but when I talk about rollover, futures have a life in the sense that they close out on a quarterly basis. So you'll find that these things trade in March, the third Thursday in March, the third Thursday in June, September, which is that futures closed out last week, and then obviously the third Thursday in December. So there's futures closed out 4 times a year, quarterly, but you can hold a position from 1 day to a few hours to a few weeks. Obviously, maximum is 90 days. So compared to CFDs, there's no rollover. Okay. Nordia, Tetoy, yes, the presentation will be available to you guys. I'll be sending the presentation, the PowerPoint presentation, as well as the recording to you guys, hopefully by tomorrow. So please go through this presentation again. Any questions you have, send me any other questions. There's a question from Thea. I was a bit confused with that, with the last MTN chart. What was advice, buy or sell? Yeah, no, both those trades were long, so we're both long buy recommendations, and obviously we closed out the trade today, so that would have been closed short positions. Okay. The question here from Eleanor, I presume it's Eleanor Jabir or E. Jabir, regarding having access to fundamental analysis on the website. If you're using the download service for the web. No, you can have access to the research platform for 30-day free trial. Thereafter, you have to open up a trading account. You don't have to trade with us, but obviously there will be a cost, a 14-month admin cost. But we just won the Stockbroker of the Year award for 3 years in a row, so why not trade with us? But that hopefully answers your question. How do you get hold of the recording? This is a question from Michael. Michael, I'll be sending it to you anyway, to everybody that's recorded, that registers for this. Some software vendors maintain that markets are being manipulated by the big players. Is this true? It's a difficult question to answer in the sense that we do see it on the market. We talk about algorithms. It's a program, a computer program that will trade one share to try and keep the market at a certain level. So yes, that does happen to a certain extent, but the word manipulation is a very strong word. The JSE Surveillance Department is very aware of any manipulation. You know, the price moves more than 5 or 10%. Obviously, it's trading suspended and that kind of stuff. So I would say the market being manipulated. Yeah, the institutions are the big players in the market. Be aware of that, but as I say, you'll take advantage of that. So hopefully that answers that question. Do you use price earnings and dividend yields to determine which shares to buy? I use, Michael, to answer your question, I use that mainly on my investment, on the investment side. There's a lot of other criteria we're looking at also. I'll look at the shares that are undervalued, that's profitable, manageable risk. Obviously, dividends are important, so I like to see dividend yield more than 5%. But yeah, if you're trading the top 100 companies, you're looking for shares with more upside potential, and obviously people go for shares that have a relative good dividend yield. But remember, another thing about CFDs, by the way, is that you actually get the dividend. You get a synthetic dividend as opposed to single stock futures where you get where they're dividend neutral. So to answer your question, from a trading point of view, yes, you might look at it. Yeah. William, what do you mean by keeping a trading journal? The idea is that I keep an Excel spreadsheet, first of all, of my trades. When I entered the trade, when I got out, so on a daily basis, obviously my costs and things like that. But the trading journal is just every trade I put on, I write down the reasons for buying the share. So obviously I print out the graph and that kind of thing. I keep a file, keep a graph. So with hindsight, I can go back and say, okay, I was using more technicals here, more fundamentals. I was feeling confident on this trade because I've done my homework. All those kind of things. The more detailed the trading journal is, the better. So it's a tool that you'd use when I say a trading journal. It's like keeping a diary. You just want to be able to, because if it's written, it's recorded. If it's not written, you'll forget about it. So that's the idea with a trader's journal. I hope that answers your question. So I don't know if it's the same question again, Stephen, regarding the rollovers. But obviously, the longer you have, if you have a trade open on Sassel and you keep on holding that position open on single stock futures, yes, you'll be rolling over indefinitely. So yeah, but obviously that's your long-term trader, okay, on single stock futures. Guys, I hope you guys have found this beneficial. Here's a question from, I can pronounce it, Jubalisa. Which are the 3 best indicators to use? I've showed you in this presentation. I'll use MACD, single stock, the slow stochastic and RSI, and combine that with on-balance volume, volume price trend, and relative strength. So there's about 6 indicators I use, and there are hundreds out there. Okay. Do I sometimes trade ungeared, not to CFDs? This is a question from Eldre Diaga. I used to, way before we had derivatives. To make it worthwhile trading equities, you need to trade big amounts. The trades must be at least 10 to 20,000 rands per trade to make it worthwhile, especially from a cost point of view. So that's where the advantage is with single stock futures. They're more capital efficient. So to answer your question, no, I haven't done it for a long time. I'm more of an investor. We talk about it ungeared. So I'll be buying shares in my long-term portfolio on the equity side. Okay. There's a lot of other questions coming through, but guys, we're running out of time. I hope this was beneficial. Any questions you guys have, please send me an email. But from my side, good luck and happy trading. So there's my email address, seanvdb@psg.co.za. There's my direct number. Any questions you have, especially market related or in this situation, the webinar. But any questions I did not answer through the webinar now, I'll be getting back to you guys on email. I hope you found this beneficial, and we talk again. Thanks for your support. But please, any questions you have or any other suggestions regarding webinars, what you'd like to see more of, let us know. We'll be sending out a survey very, very soon. Guys, thanks for your support. All the best. Bye-bye.